Hi, guys. Welcome back to another episode of the Pi Podcast. Before we start today's episode, I'd just like to say if you've been enjoying the content that we're putting out, if you do like the topics that we're touching on, and if you do want to keep learning more about it, please leave us a comment as you watch the videos. Share it, like, and subscribe, and also share it with your friends and people who you feel that you might benefit from the content that we are putting out. Now, we're really trying to grow this channel and get it to reach as many people as possible, and definitely people who would find it beneficial. So, your participation, your contributions, your stories as well, based on all the topics that we're attaching, would really be a great support to the community. So, if you do feel that you are somebody who's benefiting, like, share, subscribe, invite a friend, leave us your comments, and any engaging topics. We'll be happy to get back to you. Help us build a community of individuals who are really keen to be financially literate, be financially aware, and share their knowledge as well as we grow in this journey together. So, we are covering a topic that's very interesting today. And I think it's one that is like literally taking us right back to the basics. And when we think about the basics, of course, I'm talking about cash. When we talk about investing and building generational wealth, the one thing that it is tied to is money. And money in its purest form is cash. And when you have access to cash fairly quickly, as and when you need it, that's a term that we refer to as liquidity. So there's so many reasons why people are going to require different, levels of liquidity throughout their career journey or throughout their life and throughout their investment journey. So, what are the things that we can do to make sure that the cash that we are holding is actually safe, secure, and in a place that we can actually rely on it? What are the regulations surrounding cash that we think we know, but actually, if you dig a little bit deeper, it gets even more interesting and just gives you a few more, tricks and tips in terms of how to navigate holding cash, and so on and so forth. So, let's get started. Now, I do want you guys to stick with me. I'm going to mention a few regulatory bodies, but the whole conversation is anchored on the fact that you want these regulatory bodies on your side. You want to be participating in organizations that are regulated by the different regulatory bodies I'm going to mention. And for that reason, when you hear about them, just stick with me, get past the regulation, and really get to the meat and bones of what's being discussed. I've done this across different regions, different continents, different countries. I was just trying to get a feel for really what's out there in terms of cash, what the regulations are, say, across the UK, across Kenya, Nigeria, and India. Just looking at a couple of big economies to see what exactly their regulations are. And the interesting thing is that they all have protections that are basically meant to protect you as a depositor of cash within any financial institution or the regulated financial institutions. So if you're somebody who's holding cash, and particularly people who are nervous about investing their money, guys, this is definitely for you, okay? We're going to really analyze why it's important to have your cash, yes, have your liquidity, yes. Equally, you do need to, get yourself investing and understanding your purposes for investing so you can proceed to do so in a responsible way. So in the UK, we have the FSCS, that is the Financial Services Compensation Scheme. And this scheme is a scheme that really supports depositors in the sense that if you put money in a bank, you're protected for a value up to £85,000. Now, if you're somebody who's putting your money in your current account, in your savings account, in your cash ISA account, the reason why we have that sort of comfort and security blanket around that is because the FSCS says in the event of, say, a bankruptcy or a financial institution struggling, then we will step in and make sure that you're compensated up to £85,000. Now, we think that's the basic. No, that is just the beginning of it. To benefit from this, you really need to go into the nitty gritty and really look at what exactly that says. Many people are going to say, "Oh, well, it's £85,000. It's going to take me how long? Say, if I start investing in a cash and cash ISA, stocks and cash ISA, and if I maximize my inputs for the next 4 years or for the last 4 years, I'll get to the 80,000, so I'm safe. All else being equal, yes." you should be safe. However, there is the added component of compounding and your interest compounding and you earning more and more over time. Let's put you in a scenario where you're invested in Barclays Bank and in Tesco Bank. Now, you're somebody who has been investing in the stocks and shares ISA for the last, say, 6 years, okay? So on average, that would take you to about 120K across the Tesco and across Barclays. The two of them together would give you about 120K. Now we think, yeah, fantastic, that's a good thing because I'm protected up to 85,000. But what happens to the rest of it? So if you're saying that you're being protected up to 85,000, you have about 35,000, which is sort of sitting out there, just, facing so much risk. And we want to find a way to de-risk that type of money that you're holding. So looking really closely, we see that this is something that people don't know. Tesco and Barclays Bank actually have the same banking license. So that is where the trick is. In the UK, you are covered up to £85,000. I used to think this was in total. I can have £85,000, in total across all my, cash assets, and I'm covered up to £85,000. I was absolutely wrong about that. So you are covered for £85,000 per banking license. And that's the trick that you need to get. You need to check, where is my cash sitting and what banking license is this, building society or this bank operating under. There are a few other banks, like, for example, HSBC and Fast Direct also sit under the same banking license. We've got the ones that sit under the Lloyd's group. So you've got Lloyd's, Bank of Scotland. I think you used to have Halifax as well. I'm going to post a link in the description of this video. And that link is going to direct you to a site that will show you which banks share the same banking license. So, what you want to do, if you're somebody who's holding cash, you want to make sure that you're diversifying your cash across different financial institutions that, in their own merit, have a separate banking license to one another. And so pick one bank per banking license, and that gives you the full protection up to £85,000. Now, for individuals who are couples and you have joint accounts, I would say, then what happens here is that each person within that joint account gets an £85,000 protection automatically. So in a joint account, you have the opportunity to hold cash assets up to £170,000, and that means the full amount is protected because each person is assigned the £85,000 allowance. So I thought it would be useful to walk you through the FSCS website so you can understand how you can input the data to be able to get the output that shows you exactly how much of your funds are protected by the Financial Services Compensation Scheme. With regards to today's episode, we're talking about cash that you're holding in a cash ISA, in a cash current account, and a cash savings account. However, if you are holding cash in a stocks and shares ISA as well, then that is also within the £85,000. So keep that in mind, as that may be relevant as we go through some of these examples. But I'm hoping no one's holding, significant amounts of cash like this. However, we do get instances, say for example, where you've sold your property and you've put this money in a bank account. That's a different scenario because for that, you're protected for up to 6 months by the FSCS for up to, I believe it's £1 million. And then anything over that, I think it's probably worth looking into potentially short-term bonds just to make sure that you're doing the best that you can for your assets to be protected. Right, so we've talked about personal account holders. Now, let me just see if that gives you information. If you're a sole trader, you wouldn't be entitled to two separate claims. You could only claim up to £85,000 in total. Then you've got your joint account, which is two account holders who have an equal share. And then you've got charities and limited companies. We're not really looking at that today, or sole traders either. We'll look at that in a separate episode when you're talking about companies. But for sole traders, that is linked to personal accounts. And so it's good to be mindful of that. We talked about HSBC and First Direct sharing the same banking license. So let's say you're a HSBC account holder and you have 87,000 sitting in there for whatever reason, and you're a personal account holder. So I need to pick the FRN, my apologies, and I can check that now. That shows that you're protected up to £85,000. So presuming an individual has been saving for a duration of about 3 to 4 years, and bearing in mind that your interest is compounding, you could realistically go beyond the £85,000 threshold. And so it's useful for you to have that in mind. Diversify your ISAs across banks with different banking licenses. Now, the reason it gives you is that 85,000 is protected per person for each bank, building society, or credit union. If your UK authorized bank, building society, or credit union failed and can't pay back your money, FSCS can automatically pay you compensation. And I love that they say if your UK authorized bank. I'm presuming we haven't got any shady banking happening in the UK, but it's just good to double check that your bankers are authorized to operate on your behalf, or I guess really wherever you are on the globe, right? Just make sure that everything is legitimate and you will have no issues. Now, the good thing about this is that you can add an account. So I'm just going to add an account here, and I'm going to go with Fast Direct because I want to see what the FRN for that bank is. Now, the FRN is essentially that number that appears there, and you can find this in your statement, and it should be fairly straightforward, either somewhere on the top or on the bottom of the document, or somewhere in the document that should be included. These two have the same FRN, so I guess I could pick any. And let's just say that I have another 40,000 sitting here as an individual. Add account and see the full 40,000 is protected. So these two sit under two different banking licenses based on the feedback that this is giving us. Let's find HSBC that shares a similar FRN to the Fast Direct. And the reason I'm doing that is because when we search for Fast Direct, just to show you super quick, when we search for Fast Direct, the FRN was the same, and we're not interested in institutions that are not protected because we're basically trying to make sure that we're working with authorized institutions and we're making sure that they are protected, and anything that's not protected, we're not interested in. If you do fall in that category, you want to speak to your bank and understand what is going on there and just make sure any changes that are needed are made. So because this has one FRN, I'm presuming there's a HSBC bank with a similar FRN, 765112. So let's find that. 765112. There we go. You've got quite a few of them. Private banking, HSBC UK. Again, you've got, so if you're sitting under any of these, actually, let's do this. Let's try and say that we are that person and we are just spreading ourselves thin across HSBC. We can see those amounts are fully protected under the same license, and let's just keep adding HSBC. And let's try the private bank this time and say you have another 100,000 sitting in there in cash for whatever reason. Again, you're protected up to £85,000 and the 95,000 is not protected. Let's just add another account to be sure that we're doing the right thing and say that we are in that account. We've got another 5,000 add account. Again, not protected. Full 100,000 not protected. 40, 40 and 5, 85 is protected. We can do a similar exercise for joint account holders. So this is all personal sole account holders. So we can remove that, yes, and we can remove that because now we fully understand how that works. And the good thing as well, when you do the joint account holder, they'll show you exactly at the bottom of the output, they do explain to you why you're getting the results that you're getting. So there's no confusion. So let's say that you're a HSBC joint account holder and we're going with one of the, I mean, I don't want to say private banking because that covers a small proportion of people. So let me just take one that covers more people and say we have 190,000 there and we are joint account holders. Voila. Each individual has 95k sitting in that account and only 85k is covered, 20k is at risk. Now we can add another account and say First Direct. Let's go with that. And we can add another 50,000 as a joint account holder. And again, just getting ourselves more into the sort of risky area. So do what you need to get these cash holdings right if you are somebody who's holding significant amount of cash in your account for whatever reason. I know that with people who are close to retirement age or, pensioners and so on and so forth, you might need liquidity for different reasons. And you might find it prudent to hold cash, which is a conversation for another day because I'm not the biggest fan of holding cash for the sake of it. Like small amounts of cash that you might need in the next 6 to maybe 12 months, absolutely acceptable. Anything beyond that, I think there's ways that you can look at structuring that to be more beneficial for you. So, like we said, First Direct HSBC, same banking license, protections are very limited, and you do get the reasons why. It really explains it there, and the same thing for the personal sole account holders. Okay, so I thought it might be useful to also have a look at some of the more sort of trendy banks like the Monzos, Revolut, and Starling. This is covering a different age group, mostly, I guess, millennials, Gen Zs, Gen Alphas as well, I would suppose. But let's just have a quick look and see what Monzo is doing. So we're going to maximize each and every one of them across personal and across joint. So Monzo, 850k, quite significant, but you're only protected for the 85k. That was a bit of a typo, but let's just assume that you do have that much cash. Let's go back into Monzo and say that we are a joint account holder. Now, in this case, we have 170,000 for a joint account holder, and it only shows that 85k is protected for your partner. So for you, because you already have 850k sitting there and of that 85k is protected, you don't get another protection for your joint account. However, your partner will get that protection provided they do not bank with Monzo in another account. Now, let's try Revolut. And let's say we hold 40k in a personal account. The whole 40k is protected. And let's then say that we hold 120k in a joint account. Okay. Now we see that 85 is protected for you, and for your partner, they've got 60k protected from the joint account. Yourself as well, you've got like an additional 45k protected in the joint account. And then let's have a final look at Starling Bank. Okay, let's assume you have 30k in your personal account. That's fully protected. And let's say that you then have 100k sitting in your joint account. So again, this is now fully protected because you've got your 50 in your joint account and your 30 in your personal account. That makes it 80k in total, which is not above the 85k threshold. And your partner is protected for 50k in your joint account as well. Now, the UK, Kenya, Nigeria, India operate under the same sort of premise. in Kenya, they're all deposit insurance corporations. So Kenya has the Kenya Deposit Insurance Corporation. I'm going to tag it down below. Nigeria has the Nigeria Deposit Insurance Corporation. I'll tag it as well. And India has a very complicated name. I don't know why. It's the Deposit Insurance and Credit Guarantee Corporation. It's a mouthful, and I hope I got it right. So the Deposit Insurance and Credit Guarantee Corporation in India. So for these three countries, they cover you up to 500,000. In Kenya, it's going to be Kenya shillings. In Nigeria, it's going to be the Nigerian naira. And in India, it's going to be the Indian rupee. So the same principle applied in the UK is what is applied across these three countries. It is per banking license. So just make sure that you're not holding more than the 500,000 local currency in any bank sitting under one license. So you could have, perhaps cash across different branches of the same bank, or banks sharing the same license, and altogether it spreads to about, say, 1 million. You're putting yourself at risk there, because if that was to go bust, then you're only covered up to 500,000 local currency. So just be careful about that. Look into it and diversify into another financial institution which sits under a separate banking license. These are simple tricks that we can all do to make sure that we're protecting our money. And I definitely want you guys to go in and have a look. Now, I understand for the UK, there is some consideration about this moving from £85,000 going up to £110,000, but that's not confirmed yet. I understand for Kenya, it's gone from 500,000, potentially considering going up to 1 million, because the middle class numbers are rising, and they have a lot more cash to hold. For Nigeria, I understand that recently went up from 100,000 naira to 500,000 naira. I don't know if that will be increasing, and the same thing for India. I'm not quite sure if that will be increasing, or if that will change anytime soon. But the numbers we're working with as it stands today is 500,000 across the three countries: Kenya, Nigeria, and India. 85,000 in the UK. We've seen so many banks going bust over the last several years, and we hear stories about people rushing to withdraw their money. A more recent one is Silicon Valley Bank, and that was actually absolutely crazy, guys, because somebody went on social media and started talking about how any startup that has cash in Silicon Valley Bank should really be thinking about withdrawing it, because they're panicking. There's, something coming up. It's not looking good. And all, depositors are rushing to pull out their money, going to ATM machines, going to the bank to withdraw, to withdraw, to withdraw. Now, if that happened to any bank, they are bound to sort of go bankrupt. They're bound to decline. They're bound to shut their doors, because every single customer is pulling out their money, and the bank actually relies on customer deposits to be able to run their businesses. And so, if you ever find yourself in a position where the bank that you're banking with has got some financial issues and challenges, then of course you can think about getting your money back, because the thing about it is that when this sort of incident happens, then there is a panic, but equally the process by which it takes to fully liquidate that company, to get the liquidators in and to go through the numbers and to you know take out their fees as well before you get compensated, can be a bit lengthy. So I would say, I think the good thing that the UK has done now, because previously you could only hold stocks and shares ISA in one sort of account, but now they allow you to hold it across different accounts. And so you're looking to have that diversification across providers. Yes, you may have a little bit of admin to do, but actually it's still nice to be safe. So one more thing I would like to talk about is the MMFs, the money market funds, because there's jurisdictions where people really heavily rely on MMF funds to be able to get that return that they're looking for. And MMF funds are actually not considered to be uh, cash deposits, so they are not covered under this sort of protection. Now, when it comes to your investments, I'm going to do a separate episode on this one, just so we can unpack that as well, because I just want people to have that mental comfort as you begin your investment journey, as you're going through, just doing your due diligence checks and just ticking off different boxes. I want you guys to be comfortable when it comes to what you're doing with your money, how you're keeping it, where you're keeping it as well, because that's also important. You don't want your money to disappear overnight because there's cases where that has happened. And those are some of the things that, concern people about investing. So as part of the series where I want us to build generational wealth, I want us to be mindful about where we keep our money. And I'm going to explain to you how the different regulatory bodies work to make sure that you're putting yourself in a position where you're fully protected, and we'll do something similar as well for your investments. And so perhaps that just gives you a bit of psychological comfort when it comes to investing. So thank you so much for joining us. And again, like I said at the beginning, if you are enjoying these episodes, please share, like, subscribe, comment, let us know if this is beneficial to you. Share your stories as well. I'd love to hear them. So I will see you next time. Thank you so much for being with us today. Bye for now.